All right, great. Thank you, Rod. As I said, as he said, my name's Christopher Peel. I'm the CIO of Tavistock Wealth, and I'm here to talk about how we do what we do. I'll cover some of our newer investment products that might be of interest to some of your clients. And just before I start, my background is similar to actually Rod and Peter's and Tim's in that I started my life in the city in 1986. I was at Citibank, originally started as a Eurobond trader, and then I moved over to the sales side, and I went to Salomon Brothers for quite a number of years. So my background is very much from a fixed income derivative trading sales environment, going back many, many years. So, any one of the four of us actually can take questions on bonds, because it's one of my pet, one of the things I worry about quite a bit at the moment is how do we get out of the QE cycle that we're in, because we're only halfway through this trade because the central banks have huge balance sheets. But anyway, we can talk about markets. I would like people to interrupt me and ask questions as I go through. But just before I begin, because my background is very much from an institutional investment bank perspective. 8 years ago, I didn't even know what a platform was. And listening to Novia, we currently work with approximately, I think, 22 platforms in the UK. And if I'm honest, there are 22 shades of dysfunctionality from a DFM's perspective, because most of the systems or technology, wasn't built for what most of them are trying to achieve today, with very few exceptions. But actually, Novia Global is actually one of them. Their IT it works from a client experience, from a advisor's perspective, and also from a DFM's point of view. Most of the industry in the UK is just really not up to where financial services should be post RDR, and that's just my view, kind of as a bystander coming into this from a different background. Because it's important to get that right. You're probably familiar with some of the issues that Aviva had, and still ongoing. I find it incredible that advisors and clients don't really know what their positions can be from something that started at the end of last year. But that's just me ranting a bit on platforms. But I do work with Novia. I think they are fantastic. They're the next breed of a platform provider, and they actually do a really good job compared to an industry that, by and large, I think is madness. Anyway, that's just me ranting a bit. In terms of what we do, I manage money now, or the team that I run, we manage money, I think, the way the industry is going. We use exclusive use of exchange-traded funds, because it allows us to get exposure to global markets very efficiently. We're able to do that because the ETF market has grown a long way from when I was doing index swaps at Salomon Brothers on some of the Salomon World Government Bond indices, back in the 90s, early 2000s. It's super efficient now. If I want to buy the Japanese equities, I can on TradeWeb, I can put a trade in and execute within 6 seconds and have exposure to markets that, 15, 20 years ago, you needed to have bricks and mortars in Tokyo. If you want to do something in Australia, you gave your money to Macquarie in Sydney. So I work very extensively from a quantitative perspective, solely with ETFs. We run money on a global basis. I think that the legacy issues of how money used to be run, whether it be in the UK or in Ireland or in the US, where majority of a client's portfolio would be of assets domiciled in, if it's a US investor, 80% in US government bonds or corporate bonds or equities. You don't have to do that anymore. It makes more sense if one is targeting risk holistically to use the full toolbox which is available within global financial markets. So that's something that we do, and we work very closely with the quant team at iShares to make use of many of their systems in particular to help us manage money in a very risk-controlled environment, but on a global basis. I'm not going to go through here. In terms of where we are today, in terms of funds under management, about 1.5 billion euros. And in this, by way of an introduction, Tavistock Wealth is a company that was formed from the amalgamation of a number of different financial services companies in the UK. Tavistock Wealth was my old investment company called Black Square. Tavistock Investments today is a AIM-listed company that has made some acquisitions to have a couple of advisory businesses, a wealth management arm, and a private client business. So there's 4 underlying businesses that make up Tavistock Investments. Tavistock Wealth is the fund management arm of the business. Within the advisory, we have 200 advisors that are part of the group, 50,000 clients, and we have 3.5 billion euros spread out in the various platforms within the UK. In terms of what we do day to day, or what I do day to day, I manage a team of 7 people, all highly qualified. We manage 9 UCITS funds, so and these UCITS funds are denominated in sterling, euros, and dollars. And then we also offer a model portfolio service which resonates. I don't know how it is here in Ireland, but many of the advisors in the UK, they even though a single multi-asset, multi-strategy fund might be a solution for a client, there's pushback to having one single investment. So, we blend the whole range of the 9 Acumen portfolios, which are the building blocks, into our models for those advisors who want to look on a Novia Global and say, well, there's a portfolio of 9 or 10 funds as opposed to 1. But ultimately, what we do is we're targeting levels of risk or volatility at the Acumen portfolio level from low to high, and same thing in the models. So in the offshore space, the models are called global portfolios as part of the global service. By all means, stop at any time. I'm happy to talk about markets, which I will at the end of the presentation. Just here's a snapshot of the team. John Leeper joined 18 months ago. He's my number 2. He came from Morgan Stanley, Credit Suisse. Very smart fund manager. And then I've got, I call them the bear cubs down below. A team of 5 very smart graduates of different ages. I kind of run this the way, I set back the clock to when I was at Solomon, where we would just hire very smart young kids and give them, put them on the steepest learning curve you can imagine. And that's what we have underpinning the investment proposition within the firm. There's not many of us, but we work very well together. In terms of our vision, I've already touched on this. One of the things that I'm particularly proud of is if you look down at our portfolios, you can't actually tell where potentially the client that would otherwise be most attracted to that portfolio will be domiciled. I do think it's crazy to have a home bias in the current environment where you can go global. But the key thing is if you go global, you need to have a healthy appreciation for your currency exposure. As a firm, my philosophy is if you're taking risk outside of your base currency, more often than not, you need to be running a currency overlay so that you're only generating return from the bond or equity markets that you're investing in. So we run a very, I wouldn't say sophisticated, but a very large percentage of our portfolios are hedged back to sterling, euros, or dollars, so as to mitigate, FX movements. That's very important, I think, in the current environment where you're having, massive movements in some emerging market currencies, but also, we've had a strong dollar, a weak pound over the last 6 months. So we tried to negate that by running a relatively, a very large currency overlay across all of our funds. And like I said, I've already touched on the fact that we take a global view. I should say, I'm not the salesman. I manage the money, so I'm not trying to sell you anything, but I'm just here to try to explain how we do what we do. We have an external risk profiling company that is probably the most widely known in the UK, Dynamic Planner, Distribution Technology. They have a risk questionnaire that is widely deemed, well, it's widely used within the UK. I think it's 14,000 advisors use it. So all of our products are risk profile by Dynamic Planner. So as an advisor, if you have a client that comes out as a 4, well, we've got a risk profile 4 investment option, whether it be at an acumen level or at a model level. That's important because it's not what we think the risk is. We have to provide a portfolio, or we have to actually lift up the hood and show them exactly how we construct risk and have built risk back through time in order to get a risk profile rating. But you can see we start from low to high. We've got a bond-only fund. Targets very low volume, 1.5 to 3.5% volatility, which is consistent with if you're running money versus the Bloomberg Barclays Aggregate Bond Index hedged on a hedge basis. The volatility of that is around 2.5. So all we're trying to do is replicate the same type of risk that's prevailing in the market at any given time, but hedging it back to whatever the base currency of the share class is. We've got 2 new funds, the Acumen Capital Protection Portfolio and the Income Protection Portfolio, which I'll spend more time on today because I was led to believe that might be of something that is interest to a subset of you or your clients. From a bond perspective, these 2 funds came out of me spending a lot of time with our advisors who are very concerned about what are we going to do when interest rates start to rise. We would normally be putting our retired or older clients into less risky investment propositions, but do we want to buy bonds when interest rates are rising, central banks are starting to reduce their balance sheets, and you've got a corporate bond market that is 3 times the size that it was in 2008, coinciding with banks having no liquidity or balance sheet to facilitate client flows. So these 2 funds, especially the Capital Protection Portfolio, is really earmarked to try and satisfy a need for the about to retired or retired segment of some of your client banks. What do we do if we don't want to buy bonds, but we still want to have money in the market? The guarantor on both those 2 funds is Morgan Stanley. First time they've guaranteed any type of product like this anywhere in the world. It's wrapped within the UCITS fund structure with daily liquidity. So if any of you have ever invested in any of the MetLife or some of the AXA products that are less liquid, have lock-ins, very expensive, this is a game changer in that industry in particular because we've solved many of the shortcomings of the protected and the insured market products that have come before us. So I'll spend more time on those. And then you can see, as we go down the list, we're targeting higher and higher levels of risk or volatility. Different levels of AUM. You can see that the majority of our investor base tends to be in profiles 4 and 5. That's just the way the risk questionnaire has come out. I imagine it's pretty consistent with how your client base is. I'm going to go into the new funds, because, like I said, that's what I was led to believe. This is, as I just said, I spent, you've got to kiss a lot of frogs. One of the things I did when I was at Solomon, which was then Citibank, because I started Citibank, went to Solomon, and then Citibank bought Solomon, so I ended up back to where I started. But I also ran derivative sales. And I know, it was true back then, it's true today, the client experience in the traditional structured product market, the client experience tends to be pretty poor. They spend an awful lot of money, they pay a lot of fees. Sometimes it works out, but the reality it is, either the intermediary or the bank tends to make the majority of the profit from those. That's not going to help someone going into retirement. So I went around to all of the structured product providers, the banks, and said, look, I want to change the game. I want to actually create something that's liquid in a regulated format that gives the client the ability to have protection in the event that either interest rates continue to rise or there's a big sell-off in equities. What can we build? And that's really effectively what the 2 new funds are. The Acumen Capital Protection Portfolio, and these are Irish structures, launched as sub-funds within FundLogic, which is Morgan Stanley's Irish OEIC. The first one is 90% of the highest ever NAV or max NAV is protected at all times. So these are a lot better than something that has an 80% initial investment protection level with a 5-year lock. This is 90% of the highest NAV of that fund is guaranteed by Morgan Stanley. And I'll go through that in the presentation. Morgan Stanley, credit rating A1 on Moody's, A+ on Standard & Poor's. So this isn't a soft guarantee backed up by a collateralized portfolio of junk bonds that are worth 50 cents on the dollar when you need it most. This is guaranteed by the balance sheet of Morgan Stanley & Co. International. You know, I think it's a big deal, but also the fact that 90% of your profit is locked in, or 85% of your profit is locked in, you know, when you own the fund. We've got sterling, euro, and US dollar share classes. We launched these in May. Since May, we've got about 75 million pounds in them, which might seem in some cases like a good launch. It's not really, because we've had just administrative problems getting the funds available on the platforms, because unlike Novia, who will upload a new fund within a week, a Standard Life or a Zurich will take 9 to 12 months just because they can. So what we're finding is that the 3.5 billion euros that we have in the business, of which we manage about 1.5 billion, we can't get access to it because a lot of it will go into the new funds, but these are very cumbersome legal agreements that Morgan Stanley has to negotiate, because legally it's their fund, not ours. So I would expect AUM to grow, and grow quite markedly, just from within the group, but also externally, in light of how we've structured them. In terms of what it is, it's an option-based strategy where the underlying portfolio of ETFs is the same underlying portfolio that I've been managing for the last 4 years in the Acumen Conservative Portfolio. So that targets volatility on an annualized basis between 5 and 7%. So slightly, you know, a low risk corporate bond volatility risk profile. But you can see in the asset allocation, we've got government bonds, corporate bonds, inflation-linked bonds. You know, where on a regional basis, we've got half the portfolios in the US, only because the benchmarks that we're using are the MSCI World Equity Index or the Bloomberg Barclays Aggregate Bond Index. So half of those indices have US exposure. Most importantly, I'm taking that dollar exposure and hedging it back to dollars, euros, or euros or sterling. So the Acumen Capital Protection Portfolio targets volatility of 5 to 7%, and the highest ever NAV, 90% of the highest ever NAV is guaranteed by Morgan Stanley at all times with daily liquidity. The Income Protection Portfolio is exactly the same thing, takes slightly more risk, targets slightly higher volatility of 7 to 9%, but only 85% of the highest ever NAV is guaranteed, mainly because with a riskier portfolio, the way the put option's working, it's too difficult or too tight to manage money without the participation rate being unusually low. In terms of who's doing what, and there's a lot of information, so you can take away and ask me questions at a later date, but I came up with this idea with Morgan Stanley, and the reason it works, and it works at the moment uniquely with us, is that I have a long track record of targeting or delivering the amount of volatility at a portfolio level that I say I'm going to. In the Acumen Conservative Portfolio, the third one down, we target risk of 5 to 7%. The back-tested numbers of my portfolio, even going back all the way to 2002, Morgan Stanley calculated my portfolio volatility came in at 5.7, so just below the mid-range. Their numbers, not my numbers, that's really important. On the income portfolio, 7.1 to 9. Over that same period, the level of volatility that it came back at is a little over 8%. So what I'm very good at, I can't tell you how much money I'm likely to make in the portfolio for the client. But by targeting risk at an asset class level and letting my asset allocation and diversification do the work, I know that I will always be within my targeted volatility range, which then fits succinctly with the client's attitude to risk within Dynamic Planner or whatever questionnaire you're using. So the whole idea is to have some predictability, and because if Morgan Stanley is going to be giving a guarantee on me doing my job, they need to have we went through a fair amount of due diligence on the systems we use internally, our approach to risk, and how we trade, how do we try to immunize against tail risk, etc. So Morgan Stanley is taking a big risk on Tavistock and me and my team that we're able to keep within our very clearly defined volatility ranges. So,
sorry, maybe I'm jumping the gun, but what type of returns would you be getting on those types of funds?
well, I've got the returns. I'll get to those returns on a back-tested basis. You know, obviously, over the last 10 years, you've not needed protection, okay? But in 2008, 2009, for the older ones here, those were terrible meetings with clients. You know, you lose 25, 30%. You know, when you need it, and you can't buy it. So what is the risk? You know, what are you willing to pay for effectively insurance that things might not go so well? I mean, I'll show you the numbers. It's a little over 1% effectively. You're paying 1% to immunize against, you know, not Armageddon, but, you know, I think in bond land, you know, if we just go back up to normalized rates, whether it be in Europe, the UK, and maybe in the US, you could easily see a 1.5 to 2% lift in the level of the yield curve. And if duration is 10 years, that's 20 points, at least. You know, well, what's 10 points on 1 year? 10%, you're going to lose 10% just if you go there. You could blink and we could be there. And, you know, talking to Tim earlier on, because he's old, you know, not many people remember what happened in 1994. It was horrendous if you were a bond investor. And I think generally a lot of people don't. It's been, well, my team, smart guys, kids. John, my number 2, started in 2009. I think, and that's probably consistent within certainly the UK financial services. 80% of the professionals managing money or trading have only been in a bull market for equities and bonds. So what is going to happen? You know, there's all sorts of, you know, we're already starting to see, it's been an ugly last 4 to 6 weeks in markets, mainly coming with the contagion and the brats, Brazil, Russia, Argentina, Turkey. It's starting to seep into other things, and it's seeping into the bond market. Not so much the government bond market. German bunds are near record lows, and gilts and treasuries, you know, 10-year rates haven't moved much. But the damage is being done below the surface, because everyone's looking at the tip of the iceberg. The tip of the iceberg is where's the 10-year U.S. Treasury, 286. Who cares? Because I can talk about markets much more efficiently than I can about these. Most people own corporate bonds, spread product. Spreads are starting to widen. So the damage in corporate bond portfolios isn't because the 10-year has moved 5 basis points and might go up to 3.25. It's the magnitude and the size of the corporate bond market, whether it be in Europe or in the US, that someone needs to buy this stuff matures and has to be refinanced in the next 5 years. Banks have no capacity to underwrite deals anymore. Banks don't have the ability to facilitate client flows the way they used to. So I think, going back to why these products are important, you know, trying to get out of the way of further losses in bond portfolios for the most conservative of your client banks. So the people that can least afford to lose any money, I think it's ideal. You would otherwise stick them into a bond portfolio. Well, you don't want to do that, or you want to do less of it. You don't want to put it into a full-fat US or a global equity portfolio. That's probably a better trade than necessarily going into bond lands, but to have some sort of a cushion or a an anchor over the side. These two funds, the way we structured them with daily liquidity, I think I'm convinced we're going to I think people will try to replicate the funds, and money will flow. It just means, unfortunately, most people have to lose money before they realize, well, I wish we should have done that. So anyway, but both these funds, they're multi-asset. The underlying track record is from the existing funds, which we've been managing for at least 4 years, if not longer. Large amounts of diversification. In terms of what I do, I manage the basket of ETFs, just like normal. I hedge my FX and my duration. That's what we do day to day on the left. Morgan Stanley is in charge of making sure I don't do something wrong compared to how I normally manage my risk. So volatility control, what they're effectively doing is selling it's an option-based strategy. They're selling a put into the fund to sit alongside the basket of ETFs, which effectively is guaranteed, which is struck at the level of the target volatility of the fund. If I manage to 6% vol, the put is struck to 6% vol in the middle, and what they do is they monitor the exposure between the amount of money that's in the basket of ETFs and or cash. So every day we have we don't have flows every day, but the participation level or the investment in the basket of ETFs is not constant. If volatility in markets rises, which it has done, we'll go from 100% investment in the basket of ETFs to maybe 80. So it'll de-risk. When volatility is rising, it'll just take money off the table. And I've got the back testing which shows that's highly effective if we're going in, if one thinks you're going into a period of just losses, whether it be bonds or equities. And I'll show you the back testing. So we work in partnership with Morgan Stanley. Effectively, their neck is on the line. Their credit, their balance sheet's on the line to make sure that I don't drop the ball. And the good thing is it's a daily mark to market, not only at the fund level.
It won't get too big for Morgan Stanley to not apply the guarantee.
No, I think the options market, well, yeah, you'd have to go into the billions, but it's for the 90% protected portfolio, effectively they're writing a 10-point out of the money put at whatever the highest NAV is, struck at it, 6% vol. That's a pretty liquid structure. I don't think there's not going to be any issues. But in terms of the original length, the Morgan Stanley's, the initial period, it's an open-ended fund, daily liquidity, but the put has an original life of 4 years. Okay, so what we're going to be doing is after 18 months, when we're looking to sell an 18-month put with 2.5 years to run, and then buy another 4-year structure. It costs approximately 1% per annum to have this insurance, but it's very powerful. It'd be less sexy if it was just a guarantee of your initial investment. But if markets rise and the NAV goes from 100 to 150, it's not 90 cents on 100 that's protected. It's 90 cents on 150. That's very differentiated from, it's much more compelling to put this into a portfolio. But obviously, once you make 10%, well then, from your initial investment, you're 100% guaranteed.
Does the cost of then the put option go up though if one is increasing, like when you're renewing them?
Well, Morgan Stanley have looked at it going back 25 years, which is why we originally decided to buy a 4-year put. And we don't have a set roll date, but after 12 months, we'll be looking to roll for another 4-year period. So we're going to sell a 1-year-old, a 1-year option with 3 years to run. So there's a window. The worst case scenario is we can't roll the put ever. So after 4 years, we can't renew the insurance. But so effectively, the worst case scenario is we'd have to say, look, we're going to have to shut the fund, but you're still guaranteed 90% of the highest NAV after the 4-year period. They've modeled it, and they're very comfortable that they're going to be able to roll this at a consistent sometime over after 1 to 4 years, it would be highly unusual. And they backtested that through 2007, 8, 9, when volatility went sky high. They were still able to roll it during that period.
Chris, one of the challenges in funds of this nature is that they get cash locked. So the volatility goes up, the price of the fund has increased. The underwriter or the guarantor decides, you know what, the only way I can assure 90% is to shut this down to cash. So we end up with a completely divested fund.
Correct.
How do we...
There's no possibility of cash lock, because you can't cash lock a UCITS fund.
Just one thing, and apologies to interrupt you. Is it okay, because there's some good questions there, and I won't be able to pick it up because you're mic'd, that you just repeat the question?
If I can remember the question.
Okay.
Maybe I might have a better chance of answering the question if I can repeat it.
It's just to tell the viewers.
Sure.
Because you don't watch videos and you can't hear the question. You can speak.
Right. Your question was about, can these two funds cash lock? Are they CPPI? The answer is no, they're not. They're not constant proportion portfolio insurance. There's no possibility, because what's actually happening is, because I don't want to stand, too dangerous. If you look here, actually I will stand here. Right, this is the portfolio here. So year one, it's at 100, the max guarantee is 90, okay? For whatever reason, there's a market crash. CPPI cash lock, it's exactly your question here. What actually happens is the exposure to the ETF basket was effectively 95. It falls to maybe 65, and the value of the put is 25. So what happens is this allows me to live to fight another day. So rather than going to cash lock, what actually is happening is I'm selling out of the ETF basket, which is highly liquid, and then the value of the put, because you remember the put's 10 points out of the money. If I were to fall 6 points, well, the value of that put is going up. So it acts like an airbag. You know, it cushions the fund when it needs, you know, either the value of the ETF basket has fallen or the level of volatility has risen above the volatility in the put. It starts to move money out of the basket into cash. And also, which has to coincide mathematically with the increase in the value of the put. So the red is a larger percentage of the box. And in year two, the market recovers. So what you can see is the guarantee, because it hasn't made a new high. Okay, here it hasn't made, it starts at 100, and the value of the ETF basket goes down to maybe that's 70. That means the value of the put has to be 20, because the max NAV is 90% of the highest NAV. Year two, the market recovers, the value of the ETF basket goes up, and the value of the put has to fall, but we haven't made a new high. So it means that the max NAV is still only 90. That's where you are. But after year three, again, the market recovers, you reach a new high, and the max NAV now is, 110. So this is what is hugely differentiated from the CPPI structure. We can still divest from the basket of risk assets, but because it's a put-based structure, the put goes up in value. The level of investments in the ETF basket falls, but then as the value of that basket increases, the value of the put falls. So it's like an airbag in a car crash. I've not seen any of this. I've not seen anything like this in the market, certainly at not a 90% threshold. This is why Morgan Stanley's, with all due respect to Tavistock, we're tiny. We're tiny. But because it was sort of my idea, they felt obliged to work with us. And we've got the might of a Morgan Stanley, which is arguably one of the top 2 or 3 investment banks in the world, standing shoulder to shoulder with us. And it's not as if they're just providing the guarantee to a fund that we manage within our own OIC. we're actually managing as a sub-fund within their OIC. So they have loads of risk. So it's, I suppose it's a, it's a soft endorsement of how we manage money. Because we manage money very differently. I only target risk, I only target volatility. I can guesstimate as well as anyone, I suppose, what I think equity or bond markets are going to do. But the one thing I do know with a higher degree of certainty is if I'm targeting 5 to 7% volatility, that my portfolio, EM crisis or no EM crisis, is going to deliver 5 to 7% levels of volatility throughout time, throughout, that's the whole idea. Anyway, that's a good question. This is not a CPPI structure. There's no possibility of cash lock. You've got daily liquidity. You get your money back the next day. And again, this is just more of the same. You can see here, if in a bull market, you've just lost money, you would have been better off buying the unprotected version because you're always going to underperform because there's about a 1% drag. But here, as an example, a V-shaped recovery, if the fund were to go to 110 and then drop to 90 cents, you can see that your guarantee is still at 99 because it went up, which is 90% of 110. So it does re-engage, it does reinvest, so it smooths out the loss profile. And you can see here, in a bear market, if the fund goes from 100 down to 80, the red line means it flat lines at 90. The most you could ever lose is 90% of the highest ever NAV. And that's just more of the same. And again, on the right-hand side, if the fund were to go to 200, it's not, 90 cents isn't protected. It'd be 100 and whatever it is, because it goes more than 200. I can't see the number. Maybe it's 230, and the protected level is 193.5. So you're locking in 90% of your gains as well. That's very powerful for a conservative investor. Does that make sense on how it works mechanically? And this is just another way to look at it on the 85%, the income protected portfolio. Just shows if you have an annuity and you're taking money out every year, after 20 years, if you're taking out an income of 4.25% on a straight line withdrawal, after 20 years you have no money. But if you're doing it in the protected format, because you've had fewer drawdowns, you end up having made 4.25% over the 20-year period, but then you still have 80 cents, 85% of your original capital left. That's good in retirement. But anyway, we're finding in terms of interest that it's the 90% threshold fund that's much more attractive because there's not much like it in the market. There isn't anything like it in the market. And then get to your question about the historical returns. These are numbers that Morgan Stanley ran on our funds. And what it shows is that going back to 2002, the unprotected version, the Acumen Conservative portfolio, had an annualized return of 5.58%, whereas the protection portfolio, 4.12. But on the right-hand side, you can see that over the period, the volatility of my current portfolio was 5.86. I target 6% volatility. The protected portfolio, the volatility is much lower, 3.84, which is why I think this is very, this potentially is very interesting for conservative investors. So sub 4% annualized volatility. And you can see we ran this through Armageddon, remember, 8-9, when the main portfolio lost 22%. The max loss could have only ever been 10. The max loss was 9.4% drawdown. But to answer your question, it came back. You can see here, this is where the pain was. We lost 9.4%, but then you can see it didn't cash lock, and it lived to fight another day. That's what's very different in how we structured both these funds. Because cash lock is a game changer. You don't want it to buy anything that could potentially cash lock, because you can have a bad week, a bad month, and then your money's stuck in there for 5 years. So these are the numbers created by Morgan Stanley on using our numbers, our data, but through their their quant team. So this is the one I'm pleased. If I target 6% vol, the actual number was 5.86. That's over a long period of time, which they said their risk engine, their compliance team said, okay, he does target vol, and he's got a good track record, and this is just the second one. This is the income protection portfolio, targets 8% vol over the same period, 8.18%. And that's why they're happy to stand with us and underwrite the value of the put, which is effectively a guarantee from Morgan Stanley. So those are historical numbers. So on the capital protected portfolio, this is in sterling, annualized return of 4.12. That might not seem great, but you got to remember that it was pretty ugly, 07, 08, 09. So that's the net number. If we ran the numbers, compliance wouldn't let us. If we just ran the numbers from 2009, it looked much better, but you've got to put the good, the bad, and the ugly all in the same slide. So those numbers, I think, are a fair representation of what an investor could expect, even taking into account an 08 and 09 environment where, it's the biggest financial crisis since the 1930s. Didn't cash lock, lived to fight another day. This is why I think in the current environment where interest rates are starting to lift, it's an alternative that's worth considering if you've got bond holders. And you've had that. In terms of costs, we've got an AMC of 1%, an ongoing charges figure. These are all Morgan Stanley numbers, 135, 138. And then there's the new MiFID reporting charges on the right. But under the old days, effectively, the OCFs are 1.35. That compares to the previous, the AXA stuff, the MetLife. Some of these products started with 2%, if not above. So we've priced them, for the masses, and packaged them into something that is highly liquid, highly regulated, and guaranteed by a real guarantor, not something that is a basket of collateral. Morgan Stanley is the guarantor. I think that's all I've got on the two. Oh, well, here's just a slide. I'm happy to. Oh, Rod can maybe circulate this.
Yep.
This just shows the difference between what's kind of come before simplistically. I think our funds do change the protected fund marketplace. The average structured note 70 to 80% protected, or 90 or 85. Annual management charges 1.5 to 2% versus a one number, and this is the OCF. I won't go through the whole list, but it's much better in almost every category. Liquid, no, versus yes, daily option, daily dealing. No ability to cash lock. We target vol. I think we spent a lot of time trying to, answer the Rubik's Cube of how do we create something that's value for money for a conservative investor in a rising rate environment, or rising rate environment and the end of a 8 or 9 year bull market in equities. Unless you're going to put your client portfolio to cash, how do you sleep at night? We saw what happened when interest rates rose. U.S. interest rates rose at the end of January, beginning of February to 3%. Equity markets didn't like it at all. There's a lot of sensitivities, and even today we're having a decent sell-off in European equities based on what's going on in Argentina and Turkey. I just think there's a lot of complacency in markets, based on Trump continuing to beat everyone up and get good trade deals. But ultimately, the fact is that we are approaching probably the end of one of the greatest bull markets in history. And and that's coinciding with central banks only halfway there. The trade to increase their balance sheet to the quantitative easing programs. Just because they finished buying, that's not like finishing anything. until they reduce them to zero, which means governments can issue new securities at the prevailing market yield, which has to be higher than the current level. And that means corporate bond spreads need to be issued, corporate bonds need to be issued at even higher levels. And it's coincided with US Treasury doubling the amount of issuance. The US corporate bond market's 3 times the size it was 10 years ago. Similar story in the UK. There's a lot of reasons to try to, it may be early. This may be early. But I'd rather be early in this than trying to catch it when we've had a trouncing in bond land, which will happen, has to happen. And equity markets are going to react initially very badly to that, because we've seen a couple of snapshots over the last 2 years when interest rates rise. Hang on, no one likes equities anymore. But the good news is corporate earnings are still very robust. Global growth is still at 4%. So I think the risk assets have another leg up. But everyone's too mesmerized by where they see the 10-year German Bund or gilt or treasury. It's the corporate bond market that is going to potentially cause a lot of problems. So we built this with this in mind, based on feedback from our advisors from all around the country, around the UK. We've also had interest from outside the UK in Latin America, where they're looking just to preserve capital in something that ticks a lot of the boxes, whether it be regulated, daily liquidity, guarantee. They know Morgan Stanley, so we feel that this is the timing for what we've launched is very, very compelling. We may be early, but I'm convinced that we're going to raise a lot of money all around the world, not just in the UK. Any questions? Any more questions on these? All right, how are we doing for time?
I think maybe we should talk about why it's difficult to replicate. You were talking about the word used to replicate these funds, this is the competition, the 9%, and I think it's really should explain to the audience how, based on your track record of risk volatility.
Well, it's these numbers here. We work very closely. We're one of the largest investors in ETFs in Europe. We have over £1 billion in ETFs. That may not seem like a lot, but a lot of the big investment houses, because they've got an active fund management business to protect, they can't be seen to be loading up their portfolios with ETFs because it doesn't seem right. So, we run. I come from a quantitative. Peter will know this. I come from more of a quantitative background. When we're building our baskets or our funds of ETFs, we're not looking at the track record of the ETF. It's irrelevant. What we're looking at is the index that is replicating going back a long, long time. So when we're looking at building a portfolio targeting 6% vol based on 25 years of asset class volatility, which we do, we're looking at the underlying index that are, we invest in about 70 ETFs. So we've got 70 underlying indices, MSCI World or S&P 500, Nikkei 225, the gilt, UK gilts 1 to 5. So what we do is we model the performance of the underlying market back through time, and then what we tend to do is we optimize it in 2 directions. We optimize that entire subset of, say, 70 indices. We optimize it using backward-looking data, maybe going back 15 years, to see what would the optimal portfolio weightings be over this time series, so as to get, in order to generate the highest level of return that's within our volatility target. So we do that. That's a fair amount of number crunching. The one thing I do know that's not good enough. The reason is because that time, that's in the past. What's probably more relevant, you need to have a healthy respect of what's happened. But if you're modeling risk today based on the volatility of asset classes over the last 10 years, volatility in equity markets is, up until recently was at an all-time low. Volatility in bond markets was almost to an all-time low. So if you're building a portfolio today based on those numbers, we go back to a risk environment predating 2008, mathematically you have way too much risk on. Way too much risk on because you've become complacent. So what we do is we do the whole optimization process all over again using 5-year rolling forecast returns and volatility. And we source that information, some from BlackRock, but Morgan Stanley. We have a number of vendors who we effectively buy in forecast returns and volatility and correlation analysis from. Then we build the same optimized portfolios using forward-looking numbers, and then we blend the two. Which, when I say to the people at BlackRock who look at, we get used to, we use their Aladdin risk software on an ad hoc basis. They said, well, that seems bizarre because you're sort of polluting or distilling both sets of data. I said, yeah, but if you actually take my approach, use backward-looking, forward-looking, optimized portfolios, and then basically weight them somewhere in the middle, you tend to get something that is closer to reality today. And it's been very effective at being able to ensure that I always hit my volatility numbers. And that's why we're able to work in partnership with Morgan Stanley, because if they're selling a put struck at the same level of volatility, and all of a sudden I'm taking far too much risk, there's all sorts of problems. It means we're having to sell out of the ETF basket. So the reason, and to answer Peter's question, the reason other people can't do it is because people don't, a lot of my competitors, they have an asset allocation model where they don't target volatility, they don't have a track record. I don't know if you look at the IA sector returns, which I won't even begin to rant about, but the volatility numbers of the Investment Association in the UK, you can have a global bond fund, a global bond fund on a hedge basis, the volatility of that ought to be something around 3%. Probably 60% of the global bond fund sector, the volatility is closer to 8. So that means they're doing something that not in bond land. Well, it's because they're not hedging any of their FX. So that's the other reason. It's so important that I have the currency overlay. So it means I can't ever get undone by, big swings in movement in the dollar, the euro, or the pound, or the yen, because I've taken that by and large out of the equation, and I'm generating my risk and my return from the markets or the ETFs that I'm actually physically buying, which again is somewhat differentiated because it has to be, because if you look at 200 funds in the Investment Association 20 to 60 sector, the divergence in not only return but also volatility, it can be massive. And yet the thing that's ironic is that a lot of these portfolios are being risk profiled by companies like Dynamic Planner, which I always say, what are they doing? How on earth can they get a different result than I do? It's because they don't factor in FX volatility. Morgan Stanley wouldn't be doing this with me if I didn't have a currency overlay. It'd be a total non-goer. But the answer is, I suppose I've been doing it a long time. They like the fact that when we're buying and blending baskets of ETFs, we're running numbers at an index level, not at an ETF level. That's easily said, but to get that data, to have that clean, to be able to model it is again, it goes back to the quant days from a long gone time on the trading floors where we had teams of quants that couldn't speak English but are very good at number crunching. I've got a couple of these people working for me, so I have a high degree of comfort that we're not going to drop the ball based on the way we optimize the portfolio and the way we just model risk. I'm sure people will try to replicate it because it's a good structure. The UCITS regulation is it's the gold standard within the world, but no one's been able to. I've not seen anything with a 90% guarantee in a UCITS fund structure anywhere, and neither is Morgan Stanley, which is why they're working with us.
Just conscious of time.
Yeah.
Can we at some point do a run through from a client perspective, not from the numbers? So someone invests €100,000, where do we get access to this fund? So it's a 1.35 annual management charge, we've platform charges, we've MMPI charges. So how that would translate in euro terms for the customer. So maybe we can at some point do a run through on that just to see, you know, how a statement on someone's account would look.
The real life case.
A real life case, yeah.
Sure. Well, if you, I suppose really all I need to know is really what your platform charges are.
Yeah.
And so how that, yeah, so we'd love to see one on.
Well, platform charges and what fees you charge.
What fees, yeah, exactly, yeah.
So that, so we can
Well-
just, put those numbers there. We can work out what
These,
Run through how
these numbers here, by the way, this annual return number back through time, that's a net number after fees, except platform. So the 5.58% ROR going back to 2002, that's what you'd be earning before a Novia Global charge. So that would be reduced on an annualized basis, you know, accordingly. But this is that's a net number of our AMC, our OCF, and whatever the MiFID disclosures are. It's basically, that number is what spits out the end before a platform charge.
Yeah, just to see it, just to.
And is there anything else? I know you probably have to go.
There's just one last question, which I'll just touch on, which I know hasn't been completely approved by Tavistock, but I think a very interesting development is that you hope by the end of this month in September to have the endorsement of the English Law Society. Do you want to say a few words about that?
Well, there's a couple of places that I guess I have to now. Yeah, we will be. Tavistock has entered into an agreement to provide investment advice to the UK Law Society, to be the sole provider of investment advice to the UK Law Society, which, to my knowledge, that's never been, or to our knowledge, has never been done before, where you have a governing body of that stature saying, we get what you guys do, we want you to be the default for, you know, the law firms around the country who maybe are not working with an investment provider. I mean, we have to provide the investment advice first, but so, you know, we're as a firm, you know, we've evolved very quickly. It's partly because of our track record, our approach to how we manage money and manage risk. So to get a body of that stature to say, yes, you know, we want to work with you, we're publicly working with you. Another one, you know, just to balance it out, one of the other things I've been doing is working with the UK Gambling Commission, because a lot of the gambling companies, you know, based in Gibraltar primarily, you know, they don't pay any interest on client account holdings, nor do they really earn any money out of client account holdings. However, so in a way for them to generate more return to their shareholders, if they can make an investment in the guaranteed fund, so they put 100% of the client assets in, and they make a contribution of a simple 10%, that means 100% of the client exposure is guaranteed by Morgan Stanley. They make a return on 100 as opposed to 10. So if we make, say, 5%, they make an ROR of 50% on their 10% investment. It's one of these things where everyone wins. So I've been working with the UK Gambling Commission, who they'll never say, yes, this is great, but they can say, well, no, this doesn't work. But the indications I'm having is, you know, it's better than the client. In this case, the client has direct exposure to the gambling company, which is inferior to a Morgan Stanley. Gambling company can't make any money putting their money on deposit with Barclays at BBB for a month, but they can make money putting it into here, and they're risking 10% of their working capital to move effectively the guarantee off their books onto Morgan Stanley's. So that will be a big coup, I think, for for these products. I just think they're structured sensibly, they're priced sensibly, and if no one knows who Tavistock is, they certainly know who Morgan Stanley is. So anyway, I'll thank you for your time. I'm happy to talk about markets or whatever off-piste. That's my day job. Good. Thank you.